Good morning, sir. Good morning, all. Today morning session from 10 to 1. Subject is corporate financial reporting. Is taken by CMA, CAR and Thakkar, sir. Sir, qualification is MCOM, LLB, DTP, DLP, SCA, CMA, CS. Sir, having 30 years experience in teaching and subject of specialization is accountancy, strategic financial management, advanced management accounting, operational research, accounting standard. Now I request sir to proceed the session. Thank you, sir.
Thank you very much.
Thank you, sir.
Okay. Good morning, friends, and happy Dhanteras, everybody. I'm starting today with revision on certain accounting standards and Ind AS. So just now there is a list of AS and Ind AS. So friends, I expect one question from this part also. Here there may be a question, old name, new name, or Ind AS number is given, and you will be asked some 4 options. What is the name of this Ind AS? So you should go for this part. This is for your information. Okay, anything can come from this. The Ind AS which I will be taking today is shown here. Share-based payment, operating segment, red, then Ind AS 113 fair value measurements, then Ind AS 115, which is a combination of AS 7 and AS 9. So I will be taking AS 7, that is, construction contracts. That will be taken by me, friends. Then I will be taking AS Ind AS 2. Both number are same, inventories, only the name is changed. Then I will go to your Ind AS 10, that is AS 10 also, and now it is named as Ind AS 16, which is a combination of old AS 6 and 10, which is regarding to property, plant and equipment. Then I will go to your AS 20, which is Ind AS 33, is regarding earning per share. Then AS 29, which is Ind AS 37, provisions, contingent liabilities and contingent assets. So these are some of the AS/Ind AS which I will be taking today, because I hope questions can be asked from this. Now, as such, friends, you all are aware, out of 1 to 29 AS, number 8 is cancelled. So in your course there are 28 AS as well as 39 Ind AS. So it is a wide course. So I will be try to justify you looking to your examination viewpoint. So first of all, I am starting with important AS from examination viewpoint, which is Ind AS 16. Property, plant and equipment. It is AS 10 in the old part. Friend, before starting, I will advise you to go through the limits for application of Ind AS. 500 crores and more, 250 crores and more. Those limits you should first understand, because question can ask from this part also. Now let us understand, friend, this Ind AS 16, property, plant, equipment. Shortly, I will call it as PPE. Now, friend, every AS you will go through, it is divided in 6 parts by the institute. The 6 parts are largely: first, objective; Second is scope. Third is some important definitions. Fourth is recognition criteria, matlab when the asset should be recognized in books of accounts. Then fifth is measurement, at what value the assets, liabilities, income, expense are to be shown in the books, that measurement initially as well as subsequent measurement. And lastly, sixth part is regarding disclosures. So in all, every AS has been divided in 6 parts: objective, scope, definition, recognition, measurement, and disclosure. So accordingly, I have tried to explain you in this lecture. So what is the objective of this Ind AS 16? The objective of this standard is to prescribe the accounting treatment for property, plant, equipment, so that users of financial statement can get information about entity's investment in its PPE and changes in these investments over the period. The principal issues in accounting for PPE are 4 items. Remember, first, recognition of the assets. First is recognition of the assets. Second is determination of their carrying amounts. Third is how to charge the depreciation and show in the books. And fourth is how to provide impairment losses in relation to PPE and how to show in the books of accounts. So this way, 4 parts are decided under these AS. Under these AS, PPE is initially measured at its cost. So I'm explaining in short how it is to be shown. Initially, it is measured at its cost. Then subsequently, it is measured using either a cost or a revaluation model. So friends, one thing is very clear. At the time of first initial recognition, you are allowed to adopt only cost model. Subsequently, at the reporting date, that is the balance sheet date, you are allowed to either follow the cost model or a revaluation model. But whatever model you have selected should be consistently used over the years. We'll discuss about this cost and revaluation model later on in this part only. And then also how they are depreciated, so that its depreciable amount is allocated on a systematic basis over its useful life. Examples of PPE: land and building, plant and machinery, motor vehicles, furniture fixtures, office equipments, bearer plants. I think, friend, this may be a new terminology, but I will explain you later on. Just now, what is bearer plants? They all are called owner occupied property. So under these AS, only owner occupied property are considered, which are owned by the owner of the entity and used by him, not meant for rental and capital appreciation only. Okay. Now go to the scope. So this is in short your objective. Now scope. What is covered under this and what is not covered under this accounting standard? So this standard shall be applied in accounting for all PPE. All PPE are included except when another standard requires or permits a different accounting treatment. So if there is some specific Ind AS which prescribes different accounting treatment for any PPE, then that will be followed. Otherwise, all PPE are covered under this AS only. Okay, friends. And whenever you find any difficulty, kindly give me the hint. I will go through it. Now, what is the property, plant, equipments to which this standard is not applied is: 1. PPE classified as held for sale. So this refers to your Ind AS 105. Then secondly, biological assets related to agriculture activity other than bearer plants. So biological assets are living plants and agriculture produce. They are biological assets. Okay, but biological assets is out of this course of this part because it is covered under Ind AS 41, which pertains to agriculture. However, one asset is covered under this, and that is bearer plant. Then third, recognition and measurement of exploration and revaluation assets. Oil exploration assets, exploration assets are not included in this because they are covered under the separate Ind AS 106. Similarly, mineral rights and mineral reserves such as oil, natural gas, and similar non-regenerative resources, they are also not covered under this. So scope always refers to what is included and what is excluded from the application of these areas. Now friends, go to some important definitions. The first definition is obviously PPE. What is PPE? PPE are tangible items. So friend, tangible, and you all know what is tangible. Tangible is one which you can touch, you can see, that is tangible. So obviously intangible assets are excluded from this AS, that is PPE, because there is a separate index for intangible assets. So basically it must be tangible items, data. So four uses of these tangible assets are fulfilled, any of one or more, then it is considered as PPE. So one, these tangible assets must be held by the enterprise for use in production, for manufacturing purpose or production purpose. If they are used, these are covered under these A's. Similarly, for supply of goods or services, if they are meant for supplying goods or services, then they are considered here. Like in first case, use in production, I can say illustration, plant and machine. For supply of goods or services, for supplying services or goods, I can say motor vehicles. They come under this definition. Just illustration. For rental to others. And fourth, for administrative purposes, like office building. So this is considered under these case because it is used for office purposes. And not only one condition, it should be held and now used. Second condition, both conditions are fulfilled, only then these assets come under the purview of this accounting standard. What is the second condition? Are expected to be used during more than a period of 12 months. So if they are supposed to be used over a period of more than 12 months, only then they are considered. If they are to be used only for 6-9 months in the year, they will be obviously expense with in P&L account. Okay friends, so the two conditions, held and used, only then this property plant equipment items come under the purview of this. So this is your one diagrammatic presentation. PPE 3 condition, tangible items held for use in production or supply, rental, administrative purpose, expected to be used during more than one period, only then it comes here. Okay friends, now the another definition which is perhaps new for you, a bearer plant. We have seen biological assets are not considered under these Ind AS, but a bearer plant is considered under these Ind AS. What is bearer plant? So it's defined as a living plant that is used in the production or supply of agriculture produce. So obviously this is related to your agriculture sector. So it is a living plant used in the production or supply of agriculture produce. Secondly, is expected to bear produce for more than one period. And third, has a remote likelihood of being sold as agricultural produce, except for incidental scrap sales, that is sale of wood, lumber at the end of the life. So normally it is not sold during its life. But incidentally, when the life is over, it will be sold as a wood, as a lumber, it's called. So if I have to give the good illustration, which easily understands this is, definition is, this standard applies to bearer plants like mango tree, mango plant. See, it covers all the three conditions. Just imagine, it is a living plant, obviously, used in the supply of agriculture produce because it gives mangoes. Bear produce for more than one period, yes, it gives mango. The mango tree gives you mango for many, many years. And normally the mango tree is not cut down during the life and sold as lumber. Only when its life is over, it stops giving mango fruits, then it is cut down and sold as a lumber. So one good example is mango tree. Similar other examples you can think of. Now I'm going to, after definition, okay, recognition. What are the recognition criteria for this? General recognition criteria. The cost of an item of PP shall be recognized as an asset in the books of accounts. Obviously, recognition heading refers to the recognition, that is accounting part of these assets. So it is said, okay, it will be recorded as asset in the books of accounts only if following two conditions are fulfilled. So what are these two conditions? One, it is probable that future economic benefits associated with the item will flow to the entity. So if I have an asset and it's going to give me some cash flows in the future, only then it will be recorded in the books of accounts as an asset. Otherwise, it will be expensive. Okay. And secondly, the cost of an item of PP can be measured reliably.
Sir, voice is inaudible. Voice is inaudible. I think you are muted. Sir, voice is inaudible.
So, students, please wait. Sir will log in again.
Hello, sir. Please log in again, sir. Please log in again.
हेलो हाँ क्या करूँ प्रेजेंटेशन प्रेजेंटेशन वेरी प्रेजेंटेशन नहीं, इंटरनेट में नहीं, वो थोड़ा क्या कनेक्शन चला गया था लाइट का, इसलिए।
Yes, sir. Please unmute yourself and you can start the session, sir. Your screen is visible, sir. Please unmute yourself.
Are you able to listen?
हाँ सर, हाँ
अब everything is over?
सर, हाँ सर, screen visible और voice is also audible, sir. Start now, sir.
Okay. Thank you. So friends, sorry friends. So two conditions to be fulfilled are future economic benefits. So I am giving one example. If any industry has built a temple in its premises, okay, and they have not put any donation box. So what will be the cost of this temple? Is it to be shown as an asset or as an expense, friends? So obviously the question is, the answer is, it is not to be shown as an asset because no future economic benefits will flow to the entity because no cash flow will come. Cost can be measured, but this cannot be shown as an asset in the books. Go to the two conditions are fulfilled. So now go to measurement part. At the time of initial recognition, measurement comes at two stages. One at the initial stage, and secondly at the stage of subsequent balance sheet. This two way it comes. So now first I am dealing with the first part. An item of PPE that qualifies for recognition as asset should be initially measured at its cost. So initially it is to be measured at cost. But then what is the cost? So what are the elements of cost, friends? So these are the elements of cost. First is purchase price after deducting trade discounts and rebates, whether received from vendor directly or indirectly through the broker or dealer. Suppose you have purchased directly from the manufacturer, then whatever discount will be given by him, trade discounts and rebates. Remember trade discount. What is trade discount, friend? It is one which is offered to everybody. You have not to beg for it. That is trade discount. Okay, and any rebate like quantity rebates or like this is given to you. So that is to be deducted. Suppose you are buying through dealer, then sometimes like a car, if you buy a car from dealer, dealer may be getting some 30-40% discount. Out of that 30-40%, he may be passing on some 20-25% to you. So that will also be deducted from purchase price, and only the balance amount will be recorded in your books. Similarly, import duties and non-refundable purchase taxes are to be added. What about GST, friend? If you get the credit for GST, then by fulfilling its required condition, then it is not to be added in the cost of your PPE. Second part, any cost directly attributable for bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management, like freight inward, installation expenses, etc. Matlab, what management thinks to be proper to make it capable of operating, those expenditures are to be added to the cost of the asset. So obviously freight inward, you know, installation expenses, you have to make a platform, and then on that platform you have to put the machinery. Those expenses will be added to the cost of the asset. Then third, the initial estimate of cost of dismantling and removing the item and restoring the site on which it is located. The obligation for which an entity incurs either when the item is acquired or as a consequence of having used the item during a particular period for purposes other than to produce inventories during that period. Here I can give you one illustration of offshore oil fields. Like Reliance is extracting oil from sea. So obviously it has to lay down the rigs under the seabed to extract the oil. Once these oil fields will be exhausted, it will have to remove those rigs, and it has to seal the seabed. All this expenditure which will be incurred after 10, 15, 20 years, you have to make the provision of these expenses at their present value, and you have to add in the cost of the asset. Secondly, I give another illustration. I want to construct my office building. I have purchased a old bungalow. I will have to demolish it, and thereafter I have to reconstruct my office or factory premises. So obviously those dismantling expenses, removing the debris and cleaning the land and leveling the land, all these expenses will be added to the cost of my factory building, friends. So this way, these are the costs which are to be incurred. So this demolition and removing cost may be incurred before installing the asset or at the time of removing the asset when the life is over. So this way, there are three expenses to be added to the cost. One, purchase price including import duties and non-refundable purchase taxes, but after deducting trade discount and rebates. Secondly, directly attributable costs. So now I'm explaining you what are the directly attributable costs. Third is initial estimate of the cost of dismantling and removing the item and restoring, that I have explained regarding Reliance oil fields. Okay, so this is a list of, this is only list, not exhaustive list, some of the examples of directly attributable costs which will be added to the cost of your asset, like employee benefits cost arising directly from construction or acquisition of PPE. So for construction or acquisition of property plant equipment, any labor cost is incurred, any staff cost is incurred specifically for that, that will be added. Then cost of site preparation, then initial delivery and handling cost, installation and assembly cost, professional fees, cost of testing, that is whether the asset is working properly after deducting proceeds from sale of any product produced during the testing period. Means in this heading, last heading, cost of testing, trial run production expenses are to be included. However, because of the trial run production, you produce some goods and they are sold in the market, then the sales value realized from sale of these goods, trial run production goods, will be deducted from the trial run cost, and net amount will be added to the cost of your asset. So these are some expenses which are to be added. Now what is not to be added in the cost of the PPE? The cost of conducting business in a new location or with a new class of customers, including costs of staff training. So your staff training expense will never be added to the cost of your asset. Or you are shifting your business to a new place, then those shifting expenses will not be added to the cost of your asset. Similarly, cost incurred in introducing new product or service. When you are introducing a new product, you make heavy advertisement. Previously, we used to show these advertisement expense as advertisement suspense account, and we used to amortize over a period of 3 years or so over the P&L account. But now as per this Ind AS, this advertisement cost, heavy advertisement cost at the time of introducing the new product or new service will never be capitalized. It will be directly debited to your profit and loss account as and when it is incurred. Then third is cost of opening a new facility. You open a new branch, that opening new facility cost will not be in inauguration. You spend some money for ice cream and parties and flowers, etc., etc. This will all not be added. Then administrative and general overhead costs incurred are also not to be added to the cost of the asset, friends. So these are some exclusions from the cost. So question can come from this part. Then subsequent cost incurred, day-to-day servicing cost. So this cost will be always expensed with repairs and maintenance cost. This is called. So it is not to be second, replacement of some parts at regular intervals, like furnace may require relining after a specified number of hours of use. In furnace, there is a very hot temperature, so it should be cooled down by lining. So this lining is to be changed after some years. Similarly, aircraft interiors may require replacement several times during life of airframe. So what about these expenses which are incurred subsequently? So entity recognize them in carrying amount of PPE if recognition criteria mentioned above are met. So the two recognition criteria we have seen, one is future economic benefits should flow and cost can reliably measurable. Only then. So if it adds to your future economic benefit, this type of expenses, only then they are to be added. Otherwise, they are to be expensed with. Similarly, major inspection expenses like vessels, aircraft, they require some major inspection after a certain period of time. Heavy expenditure on this vessel inspection and aircraft inspection. What about these expenses? So entity recognize them in carrying amount of PPE if recognition criteria mentioned above are met. Again, if they fulfill the two conditions, they are to be shown as a part of your carrying amount, added to the carrying amount. Otherwise, they are to be expensed with. Any remaining carrying amount of the cost of the previous inspection capitalized is to be derecognized. Suppose initially you make a heavy expenditure on major inspection, suppose 1 crore rupees. You estimated next time you will have to make this expenditure after 5 years. So equally 20 lakhs you debiting to PNL out of this, amortizing out of this. But after 3 years, suppose for any reason you require another major inspection and you incur another 1 crore rupees. So in that case, what will happen, friends? Your previous one, out of the previous one, only 60 lakhs was charged to PNL, amortized to PNL. 40 lakhs is still there in the cost of your asset. So what you will have to do? This 40 lakhs you have to debit to PNL, derecognition, and 1 crore you have to add. So from your carrying amount of the assets, 40 lakhs will be deducted and 1 crore new expenditure will be added. So this is the way you have to show it in your balance sheet. Now we have seen initially the asset is to be, PP is to be measured at cost only, but subsequently you have two options, cost model as well as revaluation model. If you follow the cost model, then how it will be shown in the balance sheet every year? After deducting original costs, less accumulated depreciation and less impairment loss, that will be your carrying amount. Then revalue, suppose you go for revaluation model, then you have to, after recognition as an asset, an item of PPE whose fair value can be measured reliably is carried at a revalued amount using its fair value at the date of revaluation. So how to decide your fair value, measure your fair value? For that you have to refer to Ind AS 113, which is fair value measurement. So you have to follow that Ind AS, and accordingly, if time permits, I will go for fair valuation also. Minus any subsequent accumulated depreciation and subsequent accumulated impairment losses. Revaluation are required to be carried out with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using fair value at the end of the reporting period. Matlab, every year you have to go for revaluation as per fair valuation, and the carrying amount should not materially differ, otherwise you have to again revalue it. So after revaluation, on the new value you will provide depreciation, and you will always test for accumulated impairment losses, and after deducting those you will show them in the books of accounts. Depreciation. Now how to provide depreciation in respect of PPE? What is depreciation, friend? Depreciation is a systematic allocation of the depreciable amount of an asset over its useful life. Depreciable amount is the cost of an asset or other amount substituted for cost. That is, if you are going for revalued, then you will provide depreciation in future on revalued amount. Okay, so revalued amount less residual value will be your depreciable amount for the future. Useful life is a period over which an asset is expected to be available for use by an entity, or number of production or similar units expected to be obtained from the asset by an entity. Depreciation begins. Now question can come on this, friends. When to start depreciation? So depreciation begins when the asset is available for use and not when actually used. If I take the illustration of machinery, I have gone for trial run production, and trial run production is successful and the machinery is ready for commercial production, but I am delaying its actual production on it by 2 months. My depreciation will start as soon as the machine is ready for commercial use. You need not wait for actual use of the machinery. It should be ready to use, not actually put to use. Depreciation charging ceases at the earlier of the date the asset is classified as held for sale and the date when the asset is derecognized in books. So up to what period you will continue depreciation? If the asset is classified as held for sale, which comes under Ind AS 105, or it is already derecognized in the books, depreciation stops. The entity can follow any of the following methods for charging depreciation. You know the methods: straight line method, diminishing balance method, and unit of production method. Now friends, impairment loss, last part. when you have to provide impairment loss. Or what is impairment loss, friends? It is when carrying amount exceeds recoverable amount. The difference is impairment loss. What is recovered? Carrying amount is the balance sheet value. That is WDV. What is recoverable amount, friend? So Ind AS has defined this recoverable amount as higher of one asset's net selling price. Any asset has two use. But there are two options available to you. You can sell it, get the sales value, or you can use it and get the cash flows. So higher of these two things, net selling price and value in use. Value in use is present value of its future cash flows, which are to be taken for next 5 years. So this higher of these two figure is to be compared with carrying amount. Suppose your carrying amount is 100 rupees. Net selling price is 105. Value in use is 95. So what is recoverable amount, friend? Higher of net selling price 105, value in use 95 is 105, but 105 is higher than the carrying amount of 100. So there will be no impairment loss. But suppose instead of 105, net selling price is 85. Value in use is 95. So one is 85, second is 95. Higher is 95, that is recoverable amount. And this recoverable amount 95, say आपकी carrying amount 100 rupees is higher by 5 rupees. Okay, so you will have to provide depreciation, you have to provide impairment loss of 5 rupees. So this will be similar entry like depreciation to asset. Similarly here impairment loss to asset, that will be your entry and it will be shown in the profit and loss account. So these are some of the part regarding this important point regarding this. Now I go to second is Ind AS 2, valuation of inventories. The old number is 2, new number is also 2. Matlab AS is 2, Ind AS is also 2. Only the name has changed. AS 2 has the name valuation of inventories. Ind AS 2 has the name just inventories. Eligible to all business enterprise, mandatory. I am talking of Ind AS 2. It's mandatory from 1/4/16/17. Now objective and scope. As earlier I said, every AS 6 parts: objective, scope, definition, recognition, measurement, and disclosures. So friend, objective and scope: to prescribe accounting treatment for inventories and deals in determination of cost of inventories as an asset and its subsequent recognition as an expense when related revenue, that is sales of inventories, are recognized. So originally it is to be shown as asset, and then against sale it is to be debited so that you can get the profit. So how to do this is described under this case. The standard deals with all inventories. So now I'm coming to scope. What is included and what is not included? Scope means. So it applies to all inventories of assets that are: 1, held for sale in the ordinary course of business. So any inventory which is held for sale in ordinary course of business of the enterprise, I can say as per company law what is mentioned in object clause. Accordingly, if it is in the object clause, it is a business of the enterprise to sell these this type of items in the normally course, ordinary course, only then it is to be included under this. That is finished goods. Assets are also sold at some point of time, but it is not in ordinary course of business, and so it will not be included in under this AS scope. In the process of production for sale, that is WIP. Third, in the form of materials or supplies to be consumed in the production process like raw material. And finally, in the rendering of services, any asset is used, that is covered under this. Now, scope means what is included. So what is included is mentioned. What is not included? This standard applies to all inventories except 1, financial instruments, which are covered under Ind AS 109 and Ind AS 32. Financial instrument refers to if I give some cash, debtors like this. Biological assets, that is living animals like cows, buffaloes, camels, or plants related to agriculture activity and agriculture produce at the point of harvest. Harvesting matlab detachment of the agriculture produce from the plants, that is called harvesting. So these are all covered under Ind AS 41. Matlab there is separate Ind AS for this type of inventories, so they are not to be considered. Like friend, I'm investor and I have invested in shares of some companies. So this comes under the heading of financial instrument, definition of financial instrument. So this will not be covered under this. This standard does not apply to the measurement of inventories. First two, financial instruments and biological, nothing is applied in respect of two. But now the remaining two item comes where the measurement, it is inventory, but its measurement is not as per these Ind AS. Remember friend, it is inventory, but the value which is measured is not as per the normal rule of this Ind AS. So what is that friend? Producers of agriculture and forest products. I will refer to question 1, which will explain you. Agriculture produce after point of harvest, mineral oils, gases, etc. So all these are the inventories for somebody, but as these are measured at NRV as per their industry's practice. Normally, we'll see in the next stage measurement, fourth element of this index. Normally, inventories are valued at, measured at cost or NRV, whichever is lower. But these type of inventories are not measured at cost, because in this type of products, cost is not determinable, so they are valued at net realizable value. Similarly, second is commodity broker or trader. They measure their inventories at fair value less cost to sell. So these are two exceptions so far as measurement of inventories are concerned. So now friend, let's go to one illustration. As I said, first, producers of agriculture and forest products. So first illustration, friend. A company is collecting gum kriya from the plant of forest. For collecting gum kriya, company has paid 5 crores to forest department as license fee for financial year 1920. Other direct expenses overhead incurred were 7 crores for the financial year. During the year, it collected 1 crore kgs of gum kriya from the forest, sold 60% it for 12 crores. The company valued the balance 40% closing stock of 480 crores. What are the valuation, whether the valuation is correct? So friend, we have seen agriculture produce valuation and forest products which are spontaneously growing, so you cannot measure it cost, so obviously they have to be valued at NRV. So this is not to be valued at cost, these are to be valued at NRV. Okay, so the normal rules of measurement of inventories are not covered under this. So this is one. Gum kriya. Gum kriya is a plantation. Okay, so it is a forest product. So it is out of the scope of AS2. Okay, now go to some definitions. Net realizable value, NRV, estimated selling price in the ordinary course of business less estimated cost of completion and estimated cost necessary to make the sale. Okay friends, so this NRV is your, I think, quite conversion in your costing. Okay, so you know what is NRV in the process costing and all these things, but let's see the illustration. Okay, so I'm referring to illustration for NRV. Remember, it is selling price final estimated less cost of completion and cost necessary to make the sale. So any selling expense are to be deducted from this. So this I'm going to your question number 2, friends. X Limited is selling refrigerator. The purchase price of one refrigerator is 15. As per the terms of sales, the refrigerator is to be delivered and installed at customer's place free of cost. But those installation and transportation cost is to be borne by X Limited, the seller. X Limited has hired Y and Company for the purpose of and is being paid 1,000 per refrigerator for delivery and installation. At year end, on 31st December 10 refrigerators were in stock. The market price of one refrigerator is 15,750. Calculate the valuation of closing stock. So my selling price is 15,750 minus I have to deduct the cost to sale. Cost to sale is friend 1000 rupees, which the seller himself has to bear. So 15,750 minus 1000 is 14,750. So friends, I am showing the answer also to you. This is the answer of this. I am highlighting here. So my NRV is 14,750. Selling price minus cost to sale. Whereas my cost is 15,000. So I have to show it cost or NRV, whichever is lower. Okay, so NRV is 14,750. So I have to show, me being the lower, I have to show at 14,750 into 10 refrigerator, 147,500 will be my valuation of these inventories, friends. Okay, so this is the way we have to value. And this is your definition of also, friend, NRV. Fair value, friend. As I said earlier, this fair value is to be taken as per Ind AS 113. Now what Ind AS 113 says is the price. Fair value is the price. Which price? Prices are two types: purchase price and sale price. Purchase price is known as entry price, sale price is known as exit price. So here you have to take the exit price, matlab sale price. That would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. Okay, so accordingly, you have to take the fair value, which is the exit price to sell the asset. If it is an asset, here inventories, obviously we take its exit price. Orderly transaction, routine way between market participants. Okay, so it does not include straight sale prices. Simple, in the ordinary course, whatever in the market you get the price, that is to be considered as fair value. Now measurement. Initial measurement should be at historical cost. So like PPE, here also inventories are also to be initially measured at historical cost, and subsequent measurement should be at cost or NRV, whichever is less. That is based on principle of conservatism and prudence. Just now in case of refrigerator, we have seen, okay, I will be able to sell at 15,750, but I will have to make expenditure of 1000 rupees mandatorily for selling it. So my net cash inflow will be 14,750. So your principle of conservatism or prudence says book your future losses but not the gains. So in future when I will sell, I will make a loss of 250 rupees against 15,000 purchase price. My net selling price will be 14,750. So 250 loss I will be booking by showing at 14,750. So this is basically whole AS2 is based on the principle of conservatism and what you can call as prudence also. If inventories are recognized on NRV, then the difference of carrying amount and NRV should be written down as an expense in the period the written down takes place. So same thing we have understood in the case of refrigerator. By showing in the stock, in debit side we have shown at 15,000 purchase cost. Credit side in inventory we show at 14,750. So obviously 250 rupees per refrigerator loss is booked in your P&L account. Any reversal write down owing to increase in NRV subsequently will result in reversal in inventories recognized at an expense. Okay, so subsequently if you can sell suppose at a higher price instead of 15,750 at 16,000, obviously minus 1,000, 15,000, so that loss will be reversed in the next year. NRV is likely to be less than cost. So when the NRV will be lower than cost, what can be possible reasons for this? So it may be increase in cost or fall in selling price, physical deterioration in the condition of inventory, obsolescence of products, marketing strategy to sell products at a loss, like penetrating pricing policy. In costing, in pricing policy, you must have learned this penetrating pricing policy and skimming pricing policy. Those who follow penetrating pricing policy sometimes sell the goods at just variable cost, ignoring fixed cost. So in that case also, your NRV can be lesser than cost. And errors on production or purchasing. Inventories are usually written down to NRV on the following principles. Items are treated on item by item basis. Matlab when you take cost or NRV, if you have 10 items, for each and every item, you will find cost and NRV and take the lower one. Item number 1, cost, NRV, lower one is your inventory value. Similarly, item 2, similarly, item 3. You are not to take the 10 items total cost and 10 items total NRV and whichever is lower here too. So that offsetting is not allowed. You have to do individually. How? Let's see, friends. Okay, first item, because a question can come on this part also, and it is already there in your MCQs declared by the institute. So recently, see the question number 30. X Limited deals in 4 products, X1, X2, X3, 4, which are neither similar nor interchangeable. At the time of closing of its account for the year 1670, historical cost and NRV of closing stocks are X1, X2, X3, 4, historical cost, NRV. What will be the value of closing stock, friends? So can you give me the answer, friend? Like X1, what is lower? 78. So you take 78. Okay. Then next 47, 43. So NRV is lower, 43. So 78 plus 43. Go on adding. Then 23 and 27. Lower is 23 cost. Add 23. Then 87 and 88. Add 87. Does your total comes to 231, friends? 78 plus 43. Okay. Plus 23 plus 87. So your correct answer will be, friends, 230. This is your. So individually I have taken, not that I make the total of 78 plus 47 plus 23 plus 87, make the total of NRV and then compare, and whichever is lower should I take. I'm taking it individually. For X1 I'm comparing the two, taking lower. For X2 comparing, taking lower. Like this you will have to take, and that way you will get your total inventory cost, friends. Okay, friends. Now the rules for valuation. Raw materials and WIP are valued normally at historical cost, but at times they are valued at replacement cost if finished goods in which they will be used will be sellable at lower than its actual cost. Whereas finished goods are valued at lower of cost or NRV. And what is included in cost is purchase cost plus conversion cost plus other costs incurred in bringing the inventories to their present condition and location. All these are elements of cost which are going through later on. So cost or NRV, whichever is lower, is for finished goods. For raw material and WIP inventories, it is normally historical cost. But the raw material which you use and convert it into finished goods, that finished goods item will be sellable at a value lower than its cost of production. Then you will value the raw materials at replacement cost. Let's see the example. Question 3. So this is your question 3, friends. These are all your past examination based questions, friends. So I have raw material actual cost 120 rupees. And in this raw material, if I spend labor and overheads, my cost of finished goods will come to 250 rupees. Now, as on the balance sheet date, the replacement cost of raw material is 120. The price is reduced in the market from 120, it has reduced to 110. There are 1000 units of raw material as on the balance sheet date. Calculate the value of closing stock of raw material in the following conditions. If finished goods produce is sold at the rate of 275 per unit, what will be the value of closing stock of raw material? Normal rule is raw material is valued at historical cost, matlab 120. But the finished goods which will be produced out of it, you will be sellable at a price lower than 250. Then you will have to value the raw material at its replacement cost, which is 110. Now in the first case, the finished goods whose cost is 250 will be sellable at 275, matlab higher than cost. So in this case, there will be no future losses. So it will be valued at its historical cost 120. But second case, if the finished product which will be produced and thereafter sold in future will be sellable at 230 rupees per unit, matlab lower than its cost price of 250. So in this case, what will the value of raw material inventory? Replacement cost, and replacement cost is 110. So in the first case, we will value at 250, 120 only. In the second case, you will value at replacement 110. So in this exceptional case only, raw material is valued at replacement cost. Okay, friends. Now, friends, what are we have seen finished goods to be valued at cost. What are the elements of finished goods cost? One, cost of purchase, including purchase price, duties, taxes, excluding recoverable by the enterprise from the taxing authorities like GST credit, freight inward, expense directly attributable to acquisition of finished goods, materials, services, trade discount, rebates, duty drawbacks, and similar items are deducted in determining the cost of purchase. But cash discount is not to be deducted. Cash discount is a financial expenditure because you are making earlier payment, you are getting this discount. So cash discount is never to be deducted from the cost of your inventory. It is to be shown separately in the P&L account as cash discount. So this is similar to your PPE. Now, what are the other costs of conversion? One is labor cost. Okay. So that is what a labor cost you have incurred is to be deducted. Second is fixed production overheads. Your overheads are of two types, production overheads, fixed and variable. Both are to be added. But what are the rules for adding fixed and variable production overheads? For fixed, allocated on the basis of normal production capacity. You friends being students of cost CMA, you know for fixed production overheads, you find for all overheads, you find absorption rate. Absorption rate is budgeted fixed overheads divided by budgeted production units. The budgeted production units is to be taken based on your normal production capacity. Accordingly, you will find the FOAR and you will apply that FOAR to your cost of production. Allocation amount is not increased due to lower production. Your normal production is 1 lakh units. Fixed overhead is 10 lakhs, so your rate is 10 rupees per unit. Now suppose instead of 1 lakh, due to some reasons, sluggish market, you were able to produce only 70,000 units. So you cannot increase your rate of FOA. 10 lakhs divided by 70,000, that you cannot do. You will absorb at 10 rupees your normal production based, remaining will be your loss under recovery. Variable production overheads on the basis of actual production. This will be on actual. So variable is on actual, fixed is on normal production, remember. Then friends, this third part, sometimes process is such, the end of the process you get 2-3 joint products. So friend, how to apportion the joint cost over the joint products that you learn in your cost accounting very well in interlevel. So joint products and byproducts, allocation of joint cost on the basis of one sale value at the point of split off, that is separation, or NRSV, final sales value after deducting post separation cost. And you also know the byproducts NRV, net realizable value, is deducted from joint cost, and thereafter only the joint cost will be apportioned to the joint products. So friends, being cost accounting students, you know this better. What are the other costs? All other costs to bring the inventory to its present condition and location are to be added. Okay, now what is not added? Exclusion from the cost, interest and borrowing costs generally. Normally, Ind AS 23, which is relating to your borrowing cost, AS 16. It has specified in normal situation, inventory does not include borrowing cost, that is interest. However, if your inventory is a qualifying asset, then it will be consisting of interest cost valuation also. Okay, but unless it is qualifying asset, nothing will be added so far as interest is concerned. Similarly, abnormal amount of wastage of material, labor and other production costs are abnormal. You know, abnormal wastage always go to P&L. So they are not to be. This also you must have learned in the chapter of overheads at your interlevel. Storage costs, unless necessary in the production process. Okay, suppose your production process requires the goods to be stored like wine. In case of wine, you have to store it for a longer period of time before they are ready to sell. It is a part of its production process that you have to store it for a longer period. In that case, storage cost will be added. Otherwise, normally the storage cost is not to be added. And similarly, unrelated administrative overheads, selling and distribution costs are also not part of the cost of finished goods inventories. Now, sometimes, friend, you purchase the inventory on a deferred settlement terms, extended credit period. Normally, the supplier is giving 60 days credit, but you ask him to give 6 months credit. So obviously, he will charge higher price from you. So that difference between the cash price, matlab normal credit terms, 60 days credit terms price, and your actual price, 6 months credit terms price, that difference is nothing but interest. So that will be spread over the period of financing. It will not be added to the cost of your inventory. Now, cost of agriculture produce harvested from biological assets. So we have seen they are to be shown as fair value less cost to sale. Okay, because cost cannot be determined. So I say the measurement part of this is not included under this, because its measurement is not at cost or NRE, whichever is lower. It is differently valued as per the industry's practice. Otherwise, this agriculture produce comes under the, if here there is inventory after harvesting, it comes under AS2. Till harvesting, it comes under 41. But after once it is harvest, okay, it comes under this. But measurement will be at NRV. In accordance with Ind AS 41, agriculture inventories comprising agricultural produce like rice, bajro, millet, etc., that an entity has harvested from its biological assets are measured on initial recognition at the fair value less cost to sale at the point of harvest. This is the cost of the inventories at that date for application of these standards. So no cost or NRV, only fair value less cost to sale. Now, which cost formula you have to apply? So this also comes in your costing, and I think you are much aware. Goods are of two types: ordinarily interchangeable, ordinarily not interchangeable. Now I am talking of first goods not ordinarily interchangeable. That is, the goods produced for specific purpose or for a specific customer, as per the requirement of the customer. Then you will take this specific identification. You will have a job card. As per the job card, material, labor, overheads, what are incurred are added, and that way the cost is to be decided. In types of jewelry business, in tailoring business, the method of valuing inventory is as per this method, because the jewelries are made as per the requirement of the customer. Your clothes are tailored as per the requirement of the customer. So specific identification. But the goods which are ordinarily interchangeable. Now friends, what is ordinarily interchangeable? So I am explaining you this. Apply for goods which are ordinarily interchangeable, like ceiling fans. Okay, you go to a shop to buy a ceiling fan. So you pick up one piece, but then after opening you find is not proper, something is not good, so you will ask him to exchange. He will give another. Okay, so you go to the shop and buy tomato ketchup. You see one bottle, but then you see its manufacturing date is little earlier, so you pick up the another. So they are ordinarily interchangeable. So in that case, FIFO or weighted average cost formula can be used by the enterprise to show the cost of the asset. So friends, remember FIFO and weighted average. What is not allowed here? LIFO and simple average are not allowed here, friends. You know this part. Okay. So this is all historical cost. No matter whatever is here is incurred, at that price you show. But in certain cases, it is not possible to measure the inventory cost at FIFO or weighted average. Then you have to go to non-historical methods, which are techniques for the measurement of cost inventory, such as standard cost or adjusted selling retail price method. When this retail selling price method is used, so may be used for convenience if the results approximate cost. The retail method is often used in retail industry like Big Bazaar. If you go to Big Bazaar, they have shops in number of units, sources in number of units, how they can sell and measure the cost as per FIFO method. Not possible. So how they will measure? They will go as per adjusted selling price method. Now, what is the adjusted selling price method? For measuring inventories of large number of rapidly changing items. Obviously, for Big Bazaar, the items which they are stored are in large number and rapidly changing. Every day, lot of turnover is there. So, but their margin is more or less similar at 10%, 15% margin on retail price. They are selling the goods. So for which it is impractical to use other costing methods, the cost of inventory is determined by reducing the sales value of the inventory by appropriate percentage of average gross margin. Friends, as a chartered accountant, I have seen so many industries also value the finished goods by this way only. It is for them, small industries, they cannot decide the cost, they cannot prepare a cost sheet, and because they don't have a cost accountant, and so they don't prepare the cost sheet, and accordingly they find the cost. How they value their finished goods inventory? This is same way. Selling price, normal selling price minus their gross margin is more or less fixed. Suppose 10%, 20%, 25%. So selling price minus 20% that normal gross margin they find as its cost. So this is largely used even in practical industries also, friends. So friends, sum number 1 we have seen, sum number 2 is seen, 3 is seen, MCQ is seen. So this way I have completed, friend, this AS2. Now I'm going to A7. So here I have written AS, not Ind AS, friends. Because so far as Ind AS is concerned, initially it was Ind AS 11 for construction contracts. Thereafter, 11, which is regarding construction contracts, and Ind AS 18, which was regarding revenue recognition. These two have been combined now, and the new Ind AS 115, has been formed by the institute, and so now this is covered under Ind AS 115, contracts, revenue from contracts with customers. That is the heading. Okay, so both your AS9 normal revenue and construction revenue both are combined and coming under the purview of Ind AS 115. So here I will go only for because this is revisionary lecture, so only main points I will take, not all the points, friends, because otherwise each Ind AS is very large. It takes a lot of time, but more important from the examination viewpoint I am taking. So remember, this AS applies to accounting for construction contracts in the financial statement of contractors only. It includes contractors, not contractees. Remember, friend. So this is similar to the contract account costing, which you learn in your cost accounting. Only some difference so far as profit booking is concerned. Okay, so there also in books of contractor you prepare contract account, contract number 1 account, contract number 2 account. Like that here also it is to be prepared. Similar way, revenues are measured, costs are measured, but the profit transfer is little bit different. So construction contract may be related to construction of a single asset or a number of assets, one bungalow or society of 25 bungalows, which are closely interrelated or interdependent in terms of the scope of the contract. All bungalows are of same type, so I can say they all are bungalows are closely interrelated, interdependent on. For the purpose of these days, construction contract has wider scope, bro. So it is going beyond construction of just building. What is included here? Extra contracts for rendering of services directly related to the construction of the asset, like service of project managers, architect. So project managers and architects will also recognize their fees as per these AS. Contracts for destruction, restoration of assets and restoration of environments following demolition. As I said, this is very wide scope. So it includes destruction of the assets also, like shipbreaking. This is a destruction contract. In Gujarat, we have Alang shipyard. Okay, their ships are broken and each and every part is sold thereafter. So it takes longer period of time. So this ship breaking is also covered under Ind AS AS7. Consultancy contracts in project management, designing, where such contracts are related to the construction of the asset. Those long-term contracts not relating to construction of asset are also covered under this. Now, so far as construction is concerned, the price may be a fixed with or without escalation clause, cost plus contracts, and mix of both. This is all you have covered under your cost accounting, friends. I'm not going in much detail. You are quite aware of this. I'm going to more important elements. Friends, what is included in contract revenue? So this term is wider than what you normally refer under your contract costing in cost accounting subject. It is revenue agreed in the contract. What are the basic price? Maybe a fixed or maybe a cost plus contract, whatever. Over and above this, what are the other elements included? One is variation in the scope of the contract. Okay, so if your scope of the contract is extended or reduced, accordingly your price may change. Okay, so that variation is also part of your contract revenue, may be adverse, maybe. If the contract scope is extended, obviously revenue will increase and vice versa. Incentive payments based on degree of certainty and reliability. Sometimes the contractor is given an incentive if you will complete with better quality or earlier than what is otherwise allowed, you will get some incentive. So this incentive is also part of contract revenue for the contractor, but it will be added only when it is reasonably certain that he will be able to claim this incentive from the contractee. At that point only it will be added, otherwise not. Based on past experience, it will not be added. Only on real situation based it will be added. Then claims, they are also to be added from in the contract revenue, and penalties due to delay in execution of the, this will be deducted. So 5 items: revenues, variations, incentives, claims, and penalties. Now let's see, friend, one illustration taking this part. Illustration 2. Contract revenue is decided. Initial contract revenue is 1000. In second year, revenue increase due to escalation is approved for 200. In third year, because of the fault of contractee, contractor is eligible to claim 1000, claim 100 rupees. Incentive payments, whatever the terms has been decided accordingly, he has finished the work, suppose earlier than prescribed, then incentive payments is eligible for 150 rupees. But in the second year, because of some mistake on his part, not following the norms of construction, he has been levied penalty of 50 rupees. So what will be your contract revenue for the year 1, year 2, and year 3? So for year 1, only initial. You have 5 items, all 5 items I have taken here. But out of that 5, first year only 1 item is there. So that is initial contract revenue 1000. So that will be your revenue for contract costing. Second year, over and above 1000 rupees, 200 escalation is approved, so it will be added 1200, but penalty is levied on the contractor for 50. So 1200 minus 50, 1150 will be the contract revenue. And third year, 1000 plus 200 escalation clause 1200 plus claim approved 100 plus incentive payments eligible 150 minus second year's penalty 50. That way it comes to 1400. So question may come based on this, whether it is to be added or not to be added, friends. So this is regarding contract revenue. Now I am coming to the what is contract cost, friend. So it is similar to your contract costing of cost accounting. Subject directly related to specific contract like bricks, steel, cement, or direct labor costs, etc. Then attributable cost relating to the contract activity in general and precisely allocable to the contract as reduced by incidental income not included in contract revenue, like sale of surplus material, disposal of contract specific plans. So obviously, friend, these all items you show on the credit side of your contract cost. Okay, so these are to be deducted from the cost. So these are the two basic direct and attributable costs. Contract costs and revenue are recognized for accounting only when the outcome of the construction contract can be measured reliably. So this is revenue recognition rule. Any revenue can be recognized only when there is reasonable certainty of collection of its ultimate income. If there is no reasonable certainty of its ultimate collection, it is not to be shown. Same thing when you show the debtors, thereafter from debtors you deduct the BDR. To the extent the amount will not be recoverable from the debtor. So here also contract revenue will be booked only when there is a reasonable certainty of its ultimate collection. Okay, otherwise it is not to be shown. Suppose I have spent 10 lakhs on a building contract, being a contractor. I have received 1 lakh from the contractee as advance. Now contractee has gone into liquidation and nothing will be realized from the balance amount. I've spent 10 lakhs, only 1 lakh I've got as advance. So 9 lakhs, there is no reasonable certainty of its ultimate collection as the contractee has gone into liquidation. So friend, I will not book only 1 lakh. I will not book the 10 lakhs. Okay, no reasonable certainty. But next year, suppose he has recovered his financial debt, okay, and he is capable to pay me, then I will record it that time. Then more other important, how will recognize the revenue based on percentage completion method. There are two methods, percentage completion and completed contracts. Completed contracts method is now not allowed by institute. Only percentage completion, one method only is allowed. So we will be booking the revenue based on percentage completion method. Contract revenue is recognized in the P&L in the accounting period in which the work is performed and the related contract cost is shown as an expense. All expected losses should be recognized immediately as an expense for the contract. Revenue earlier recognized, now becoming doubtful or unconnectable, should be treated as expense. So here also you have to show as BDR. Okay. Now friends, in contract costing, in your costing subject, normally you are getting work certified. Okay, if there is a work certified, then you take that as your percentage completion, and that revenue you take as contract revenue. But suppose there is no architect who is certifying work certified, then how will you decide the revenue? In your WIP credit side, you show work certified and uncertified work. So that figure, how will you decide based on this percentage completion? How this percentage completion is this? Let's go to the first illustration. It is based on expense incurred. A company undertook to pay contract for a building for 40 lakhs. As on 31st 3/17, it incurred a cost of 6 lakhs and expect that there will be 36 lakhs more for completing the building. It has received 4 lakhs as progress payment. What is the degree of completion? Friend, this is the question I have taken from your December exams MTQs. Latest. So cost incurred till date is 6, further to be incurred 36, means in all 42 lakhs will be incurred. Out of that 42 lakhs, only 6 lakhs has been incurred till date. So 6 divided by 42 into 100, 14.28% is your degree of completion. So your contract price is 40 lakhs. So 40 lakhs into 14.28%, that will be booked as your revenue. Here I remember, in your contract costing, friends, your rule is, if a work certified is up to 25%, no part of the profit is booked to profit and loss account. But here you will show this as your revenue, 40 lakhs into 14.28 as your work certified, and accordingly you will show it. Then I'm taking one more question. As I said, if there is a loss, actual loss, it will be transferred to P&L. But if there is future loss on completion, again conservatism comes. Whenever you have to book the revenue, conservatism comes. Book your future losses but not the revenues, not the profits. So if on completion of the contract there will be further loss, that loss will also to be provided in the current year. And this you are learning contract costing. I'm not teaching you anything new. This is as per your AS only. So I'm taking one illustration. Contract to build a bridge across river is under execution by a firm of contractors. From the following details, indicate the relevant disclosures that has to be made. So I'm not coming to the disclosure part because obviously in your objective type question, no disclosure part will come, only arithmetical part will come. So we are dealing with arithmetical part in this case. Okay. Contract price is 2000. Work certified up to the year end is 1200 and pending for certification, matlab uncertified was 480. Matlab your total WIP is 1680. Total cost incurred till date is 1680. Further cost to complete will be 520. So 1680 plus 520 will be 2200. Total cost on completion of the whole contract. So friends, what is your degree of completion, friend? Out of 2200 total cost to be incurred, 1680 is already incurred by the end of the year. So it comes to 76.36%. Okay. So what revenue will book, friends, accordingly? Your contract price is 2000. 2000 into 76.36% will come to 1527 lakhs rounded. So that is the revenue. But the credit side of your contract account, you will show under the WIP your heading 1527. Okay. Now it means you have incurred how much cost, friend, up till now? 1680. So what is your present loss? Even for the current year, if you see, cost incurred is higher than the revenue to be recognized. Revenue is 1527, cost is 1680. So in fact, you have already incurred a loss of 153. So as per conservatism, this loss will be obviously shown in your profit and loss account. This is booked without doubt. But friend, when you will complete the contract next year or so, what will be your total cost? 22. But against that, what is the contract price fixed? Is 2000. So obviously on completion, there will be total loss of 200. Out of that 200, 153 is already incurred and you are booking as a normal loss in the current year. But you have to make provision for future loss of 47, conservatism. So in all, 153 plus 47, 200 loss will be booked in your contract account. So that is what is the main things regarding this. Okay, friends. Now I'm going to the next, your AS70, which is now Ind AS 108 operating segments. Ind AS 108 says head operating segments. AS17 says segment reporting. So the rules under 17 and 108 are similar. Only one thing is changed largely, so that I will explain, but I'm basically going as per 108. But the question which I have framed and what I expect in your exam and had been asked in past examination are based on one part, reportable segments. So I will be more highlighting that part, so that in exam, if the question comes from this AS or Ind AS, you will be able to solve it. So basic of, again, in any AS, matlab 6 part: objective, scope, definition, recognition, measurement, disclosure. So objective of this Ind AS 108 is that an entity should disclose information to enable users of its financial statements to evaluate the financial effects of the different types of business activities in which entities engage and the economic environment in which it operates. Okay, so that is applicable for companies like Hindustan Unilever, which is in multi-products, Infosys, whose clients are from different manufacturing units, banking sector, insurance sector. Okay, that way Infosys has also different sectors in which it is working. RIL is also in, different segments. Okay, now it is in retail and this telecommunications, over and above that oil industries, etc. So when the company is doing business in multiple areas and all are acting under different economic environments, so it will have a lot of impact on its profitability. So they are required to give information regarding all these different segments so that investors can know what is the future of this industry. This Ind AS shall apply to companies to which Ind AS notified under Companies Act apply. If any entity is not required to apply this Ind AS but chooses to disclose information about segments that does not comply with this Ind AS, then the entity shall not describe the information as segment information. So if anything, any company is showing it voluntary, though not applicable, but if it is not as per this format, as per the rules of this Ind AS, then it will not say this is my segment information. If a financial report contains both CFS, consolidated financial statement of a parent, that is within the scope of this Ind AS, as well as the parent's separate financial statement, then segment information required only in CFS, not to give. But a company is a holding company, so it is preparing CFS as well as its separate financial statement. So if it gives this information in CFS, then there is no requirement to give it under separate financial statements. Okay. So this is the scope. To which company it is applied, to which company it is not applied, to what extent it is applied. Now some definition. Here the word used are operating segments so far as 108 is concerned. What is operating segment? Here the definition is little bit different between 17 and this 108. 108 is made more practicable. An operating segment is a component of an entity. Component of an entity, friend. Component matlab part, not the whole entity. Segment is a part that engages in business activities from which it may earn revenues and incur expenses. So this component should be eligible to earn revenue and incur expenses separately. Then whose operating results are regularly reviewed by the entity's chief operating decision maker. Normally chief operating decision makers are BOD, board of directors. Okay, but it may be other authorities also. So shortly I call it CODM. To make decision about resources to be allocated to the segment and assesses its performance. So when the question of allocating resources comes, when the question of performance evaluation comes, CODM will take this segment separately and decide, then they are known as operating segments. And for all these operating segments, discrete, separate financial information must be made available. Otherwise, they cannot disclose it. Okay, so here, out of the several business activities, which activities will be considered as reportable segments? So what is reportable segment? An entity should report separately information about each operating segment. It has to classify all these business activities into reportable, non-reportable. For reportable, it has to give detailed information. Now, how to decide this reportable segment? For which component it has to give the details required, okay, as per this, all income, expense, assets, liabilities to be shown separately. So there are some quantitative threshold limits established by the Ind AS, and if these threshold limits are observed, then those segments will be reported separately. Detailed analysis of information will be given. So what are these detailed quantitative thresholds? So in all the processes, identify CODM, who is CODM, maybe a board of directors. Then they will identify operating segments. Then from operating segments, you have to determine the reportable operating segments. And for these reportable operating segments, you will disclose the information separately. So this AS is not regarding accounting. Like we have seen 10, we have seen 2, these are regarding accounting. This is not regarding accounting. This is regarding what disclosures you have to make. Okay, so this is basically disclosure in this. Your P&L will be disclosed under this subheads of operating segments. Now, more important question which can come from this is regarding this quantitative thresholds. In past also, they've shown, they've asked from this part only. In your the question bank placed by the Institute for December, your new course examination, some questions which I am also dealing with. So question will come on this part only. Okay, so there are as such 5 quantitative thresholds. First is regarding revenue. So any one or more is complied with, then it will be considered as a reportable segment. Not all 5 are to be. Any one is one or more, it will be considered as this. Revenue, including both sales to external customers and inter-segment sales transfer, is 10% or more of the combined revenue of internal and external of all operating segments. So internal sales as a departmental transfer, what you call otherwise, branch transfers like this. So internal as well as external customer sales. Total of all segments, take 10% of this. If any segment has its total revenue, external plus internal, 10% or more of that, it will be considered as reportable segment. Second is profit or loss. I'm taking practical later on, but just first go through these conditions. The absolute amount of its reported profit or loss is 10% or more, or 10% or more of the greater in absolute amount of the combined reported reported profits of all operating segments that did not report a loss, and the combined reported loss of all operating segments that reported a loss. Means you have suppose 10 segments. Out of that 10 segments, 4 are making loss, 6 are making profits. So make the total of profit making segments, make the total of loss making segments, take the higher of these two figures in absolute terms, take 10% of that, and whosoever segment profit or loss figure is 10% or more of this, then it will be considered as reportable segment. Third is if assets are 10% or more of the combined assets of all operating segments. Assets base. Then fourth is operating segments that do not meet any of the above quantitative thresholds may be considered reportable and separately disclosed if management believes. So fourth is discretionary for the management. If management wants to show one segment's information separately, then it is allowed. So if management believes that information about the segment would be useful to the users of financial segment. Suppose company has started any startup activity. So it want to show, though it doesn't fulfill any of the above three criteria, management wants to show that we are in this type of business also. This is a new startup we have started. So it can show. It is up to the management to decide. So fourth is management discretion criteria. Okay. So this is the summary of this. With the reported revenue, both external and internal sales of an operating segment is 10% or more of the combined revenue of all operating segment. Yes, it is reported. No, go to the second criteria, which is profit loss criteria. If that is fulfilled, then it is reported. If that is also not fulfilled, go to the third 10% of assets. If that is fulfilled, the first and second is not fulfilled, but third is fulfilled, then also it will become reportable segment. But third is also not fulfilled, then you have to go to the fourth, management discretion. Whether management wants to show it separately, yes, then it will be reportable. But management does not want to show it separately, then it will be not a reportable segment. Okay. See friends, this one illustration. Revenue, profit and assets of the 4 segments of X Limited are given to you. One is pharma, another is FMCG, third is Ayurveda, and fourth miscellaneous. Total of the entities external sales 1 crore 8 lakhs, internal sales 45. But the external plus internal together comes to 1 crore 53 lakhs. Okay. Profit, so each one is making profit. Total profit is 30 lakhs. Assets totally 90 lakhs. Now one by one we'll go for. So only 3 criteria we are checking. First is revenue, second is profit, third is assets. So out of the 1 crore 53 lakhs total revenue, farmers total revenue is 97 friends. So I am going here. I am finding the percentage. This part I am done. So what is percentage sales contribution of the pharma sector? 97 by 153. That is 63.40%. So obviously it is 10% or more. So pharma is a reportable segment under sales criteria. Even if you go to the profit. Okay. Now what is the sales criteria of FMCG and Ayurveda and others? Similarly, you will find out for FMCG 4 lakhs divided by 1 crore 53 lakhs, which is 2.61%. 3 lakhs divided by 1 crore 53 lakhs, which is 1.96%. 8 plus 41, 49 lakhs divided by 153 into 100, that is 33.03. So others, this criteria is fulfilled. Then profits. So similarly, 20 lakhs divided by 30 lakhs, 2 lakh 50,000 divided by 30 lakhs, you find out the percentage. Similarly for assets, also 55 lakhs divided by 90 lakhs, 25 lakhs divided by 90 lakhs, that way you find out the percentage. And wherever this percentage are at least 10%, it will be reported. So what is the situation plan? See the pharma segment. All three percentages are 10% or more may fall ho jate. Okay, so it is fulfilling all the 3 criteria here. So obviously this is separately reportable segment. Go to FMCG. In FMCG, sales not fulfilled 2.61, profit 8.33 not fulfilled, but asset is fulfilled 27.78. So under asset test, it will be coming as reportable segment. Okay, go to Ayurveda. None. 1.96, 6.61, 4.44. None of the three criteria are fulfilled, so it will not be a reportable segment. Others are all miscellaneous. Now, the fifth condition is important one. If the total external revenue reported by operating segments constitute less than 75% of the entity's total external sales revenue. Remember, here you have to take only external sales criteria, whereas in first criteria you have to take total of internal and external, but here you have to take only external sales. So whatever segments you have reported as per the threshold limits, the total external sales of them together should be at least 75% of the entity's total external sales. If it is not fulfilled, then you will to add one more segment so that 75% limit is crossed. So additional operating segment should be identified as reportable segment, even if they do not meet the criteria, until at least 75% of the entity's total external sales revenue is included in reportable. Now friends, here if you see, total external sales of pharma is 97. Okay, because out of 4, pharma and FMCG, only 2 are identified as per threshold limits. But pharma's itself sales is 97 out of 108 of the company. Obviously, it is more than 75%. So there is no need to go for additional segment to be added, because already fifth condition is also fulfilled. So again, I repeat, friend, what are the 5 conditions? 1, 10% or more of the external plus internal segment sales. 2, 10% of results. 3, 10% of assets. 4th, management discretion. And 5th, total external sales revenue of all reportable segments under 1 to 4 conditions should be at least 75% of the entity's total external sales. If it is not fulfilled, you have to add. But here it is already fulfilled, so there is no need. So out of the 4, only 2 segments, pharma and FMCG, are reportable segments whose detailed information regarding P&L and balance sheet items is to be given. For Ayurveda and others, no need to give this separate information. Okay, friend? Let's see, friend. Second, MNOPQR, segment assets, segment results, segment revenue. Here the revenue is total. Okay. So 1200 is total. 10% of is 120. So under segment sales, these are the conditions I have written 1, 2, 3, 4, and then now accordingly we see check the results. Okay, friends. So for M, which condition is fulfilled? So for asset, limit is 20. For segment results, friend, you have to make the total of profit making and loss making. Profit is 50, 10, 10, 30. 50 plus 10, 60 plus 10, 70 plus 30, 100 total. Whereas loss making is N and Q, whose loss figure is 190 and 10, 200. Higher of the 100 and 200 is 200. So I will have to take a figure of 200. And 10% of 200 is comes 20. Whether it is a profit or loss, if their figure is 20, it will be a segment reportable. Okay. So friend, if we take first revenue, 1200 is the total revenue. So 10% is 120. Where this revenue is 120, friends? Only these two, M and N. So M and N comes under the revenue. They are reportable. Q, O, P, Q are less than 120. So they will not come. Okay. Then I go to segment results. In results, I have said you have to make the profits total, loss total. Loss total is 200. 10% is 20. So wherever the profit or loss is 20, so this is M and R. OPQ, it is less than 20. Whether it is a profit or loss, figure is less than 20, so it won't come. MN were already there in revenue, R is added in that. So now at the end of second criteria, we have three segments, M, N, and R, which are reported. Now go to assets. Total of asset is 200. 10% of 200 is 20. So wherever the figure is 20 or more, see 20 or more. So there comes M, N, O, P, and Q. P and Q exit 20. So they will fall because the limit is 10% or more. So this is exactly 10%. So it is covered. M and O were already there. P and Q, new one comes. Okay. So end of three criteria, M, N, O, P, Q. Out of 6, 5. So obviously R remains single segment. So it will obviously, when you are showing separately for M, N, O, P, and Q, then obviously R is automatically separated. So in fact, at the end of three criteria, only if you see, then all 6 are reportable segments. So your answer is this is. The difference. Okay, clear? Hope so. R is also reportable on results. Yes, R is also on reportable. So that's why I said, ne? So far as results is concerned, okay, M, N, and comes R. The 3. Then OPQ comes under the assets. So that way, all are reportable segments. MNR, first MN, then MNR, and then MNOPQ. That way, all 6 segments is your answer. So I think everybody is following this. Let's take another illustration. External sales internal. This is only for first criteria. Total is 1 crore. Okay. Now, for first criteria, you have to do external plus internal total. Segment A. 1 crore 10% comes to how much, friends? 10 lakhs. So whose total sales is 10 lakhs or more, that will come under this reportable segment. So one is A, it is 30. So about 10. Then A, then B no, C no, and then D yes. It comes under the 10% limit. Okay. So answer, threshold amount is 10 lakhs. A exceeds the quantitative threshold 30. D exceeds 54, which is more than 10. So they are 2. B and C do not meet the quantitative thresholds amount and may not be classified as record. But ultimately 75%. However, the total external revenue generated by these 2 segments represent only 70%, because you see 30 plus 54. 30 plus 5, friend, here external sales, this is 30, then this is 5, so 35 out of 50, so it is 70% only, whereas the condition is minimum 75% of external sales, the 5th one. So you will have to add one more, so that your 75, so 75% of 50 comes 37.5. So you can select any of the B or C as your reportable segments. Okay, so this is your final answer. C को भी ऐड कर सकते हैं आप, बराबर, D को भी ऐड कर सकते हैं. Normally based on the profit, we don't have the profit figures, but the out of B and C, whosoever is showing higher profit may be selected. Okay, so that your total 37.5% limit is crossed. So A is there, D is there, and you have to select one out of B and C, whatever management thinks. So that way, 3 segments will come under your reportable segments. And friends, last point of this is regarding assets. This is a past examination question in your routine course when your full patient style was also there. In your assets, you have to omit DTA, deferred tax assets. Tax assets are not to be considered as part of your assets. So excluding deferred tax assets, what is your assets? That is to be considered for your 3 number threshold limits 10% of assets. So this question is relating to the ABC has three segments, namely ABC. The total assets of the company are 10 crores. Segment A is 2 crores. Segment B has 3 crores and segment C has 5 crores. So total 10 crores is divided as 235 rather. Deferred tax included in this is 0.5, 0.40, 0.30. Okay. So assets you'd see 10%, 20% comes to 2 crores. So asset every three has 2 crores or more. So accountant says all three are reportable segments. But as per the rule of this Ind AS, you have to exclude the deferred tax assets. Segment assets do not include income tax assets. So in first, if you deduct from 2.50, it comes 150. In second, 260. Third, it 470. So total segment assets comparable for this criteria is 8.80, and 10% of 8.80 comes 0.88. So whose assets are 10% or more, or that is 0.88 or more, they will come as reportable segment. Incidentally, A department is 1.5, so above 0.88. B is 2.6, so above 0.88. C is also 4.70, that is above. So as such, each and every segment has assets criteria being fulfilled. So all three are reportable segments. But remember, like after excluding DTA, one may be skipped from reportable. So you have to check. So you compare assets after deducting your tax assets. Okay, friends. Now I am giving you two questions, friends. First, 35 number and 36 number, and giving you 2 minutes time. Can you identify the reportable segments? First question 35 is regarding profit loss. So you have to make the total of profit. You have to make the total of loss. Take the higher figure in absolute terms and take 10%. So loss figure is 200, 350 and 50 is 500. Profit figure is 250 plus 150, 400. So highest is 500. 500, 10% is 50. So whosoever is profit or loss is 50 or more is a reportable segment. 50 or more. Sorry, 500, 10% is 50, na? Yes, friends. Loss total should be 600. Yes, check it. Yes, it is 600. So 600, 10% comes 60. Correct, friends? 200, 350 and 50. So it comes 600, not 500. So one loss total is 600, profit total is 400, higher is 600, take higher 600, 10% of is 60. So whosoever figure is 60 or more, whether profit or loss. So friends, now you must have realized the answer is okay. Z is 50, so it is not covered under this. Chalo, next question. Here deferred tax assets are given, so you have to deduct deferred tax assets and then you have to compare. So 20 minus 10 is 10, 60 minus 8 is 52, 120 minus 6 is 114. Okay, total of the assets 200 minus 24 is 176. So 176, 10% is 17.6. So whosoever it comes 17.6. So only these two, M and P, will come under this criteria. This is 20 minus 10 is 10. So it is less than 17.6. So this will not be covered, friends. How many of you are giving the answer me? All reportable segment except Z. Okay, fine. That is okay. Okay. So those answers are correct. Now give me answer for this one. Deferred tax assets are to be excluded, and then you have to take total assets, and then you have to take 10% and compare that 10% limit with each department's asset excluding deferred tax assets. So friends, assets total is 200. Deferred tax assets total is 24. The 200 minus 24 is 176. 176, 10% is 17.6. Now check after excluding deferred tax assets where the 17.6 figure is touched. M 20 minus 10 is 10, so not touch, so won't be coming. 60 minus 8, 52 coming. 120 minus 6, 114 coming. So your answer is, friends, as shown here, P and N. Answer is D. This is your past examination sum, huh, friends? I have taken from your papers. So answer is D. The difference. Take the last one, which is theoretical one, friends. The company has an inter-segment transfer pricing policy of charging at cost less 10%. Cost less 10%. Inter-segment transfer pricing policy. The market prices are generally 25% above cost. Policy adopted by the company is 1. Correct as per AS but not as per Ind AS. Not correct. Correct if total transfer is below 10% of total revenue of the company. And 4. Always correct if applied consistently. So friends, it is contained in this Ind AS that if for inter-segment transfer pricing policy, whatever policy is decided by the management is followed consistently over the years, then it is allowed. Because segment results when compared with 2 or more years will not be affected by this. So answer is, friend, here I can say is D. AS not is guiding you to which transfer pricing policy should be followed by the company. You can adopt your own policy, but should be followed consistently so that 2 or more years figures are compared. Okay, so same thing is there. So according to me, the answer is always correct if applied consistently, friends. So this way, at this point, I have covered important points from examination viewpoint so far as your Ind AS 108, that is a 17 segment report is concerned. Okay, friends. Now go to one more Ind AS. Again, good practical. I have taken those AS Ind AS which are more practically asked. Okay, and I hope so in your coming exam in the new pattern, questions will be more on calculation. So Ind AS 33, which is AS 20, EPS, earning per share. This you may have learned in your other accounting part also. Let's see what is contained in this. This is also practical, quite practical. It comes into effect in respect of accounting periods commencing on or after 1/4/2001 and is mandatory in nature. So this I am taking based on AS, not Ind AS, because Ind AS are very recently applied. It is applicable to the following types of enterprises whose equity shares, potential equity shares, are listed to be listed on a recognized stock exchange. It is applicable to all listed companies. Secondly, however, under Schedule 3 of the Companies Act 13, every company is required to disclose EPS in accordance with AS 20, that is 103, that is 33, whether listed or not. So friends, end of this second situation, you can say this AS is applicable to all companies, private, public, listed public, unlisted public, all companies. Because under the Companies Act, all companies are required to show their EPS. Okay, so it is applicable to. And this Companies Act also requires two types of EPS to be calculated and shown: basic EPS and diluted EPS. Now let's go to first basic EPS. What is basic EPS, friends? Basic EPS, see the formula. As such, the word is earning per share. So what is normally comes in your mind? Earning, profit. If there is a profit, then there is EPS. No, friends, it's not so. If there is a loss, then also you have to show the negative EPS. So the formula is net profit oblique net loss for the period attributable to equity share. Okay, so you have to find out the net profit or loss which is attributable to equity shareholders. So that definition also we are seeing what is attributable to equity shareholders. Weighted average number of equity shares outstanding during the year will come in your denominator. Okay, so steps. Find NP or loss for the period after recognition of all items of income as expenses that period, including tax expense and extra. In short, you take your PAT first of all as a base. PAT, normal PAT as per your P&L account. Then amount of preference share dividend in respect of both non-cumulative and cumulative, and any attributable tax thereto is to be deducted from this profit. Okay, PAT minus preference share dividend, whatever type of preference shares, cumulative or non-cumulative, the dividend including dividend tax thereon is to be deducted, and then the profit which you get is defined under these AS as profit attributable to equity shareholders. So it is PAT minus preference dividend including dividend tax. Okay, that is to be considered for your calculation numerator purpose. For denominator, item number 3, computation of weighted average outstanding equity shares. It should be computed adjusting for the change in equity shares with corresponding change in resources. That is, new issue, money comes. Right issue, money comes. Conversion of preference shares or debentures, matlab equity shares come. Your denominator, numerator are changes in that case also. Conversion of warrants, etc. No such change will be adjusted if there is no corresponding change in resources like stock split, bonus issue, reverse stock split. मतलब 100 का से 10 में स्प्लिट होता है या 10 का कॉन्सोलिडेटेड होके 100 का 1 होता है, तो उसमें कोई रिसोर्सेस प्लस माइनस नहीं होते हैं. So in that case, your shares will not change. Similarly, in bonus shares बराबर will not that way change. मतलब they are to be all considered. बराबर. How? Let's see. So there are 4 things which are affecting your basic EPS: partly paid up shares, bonus shares, buyback of shares, and right issues. What are rules in short? Partly paid up shares should be counted as fraction of equity in the ratio of amount paid up to the total value if they are allowed dividend participation on proportionate basis. Now friends, if you have 1 lakh shares at the beginning, 10 each, 10 paid. After 6 months, you have issued another 1 lakh shares for cash, but only out of 10, 5 paid up. So how will you consider your weighted average number of shares? 1 lakh into 10 by 10 paid up value into 12 by 12 full 12 months. Matlab I am giving 2 weights, one value weights, another time weights. So both are full 10 by 10 and 12 by 12. But another 1 lakh shares which are issued partly paid, half paid after 6 months. What will be its numbers for weighted average? 1 lakh into 5 by 10 value weights into 6 by 12 time weights. Okay, so they will come 25,000. So 1 lakh plus 25,000, 1 lakh 25,000 will be my weighted average number of shares in that case. That is partly paid shares. So 2 types of weights: value weights give, time weights give, and then you find out your weighted average number of shares outstanding during the corresponding period. Bonus shares. As I said, bonus issue is without exchange of resources. That is, bonus is without consideration. The issue is treated as if it had occurred prior to beginning of the current financial year. Prior to beginning of current, matlab previous year. Okay. Also, basic EPS of the earlier financial period should be adjusted assuming equity shares of that period. Suppose after 6 months, company is issuing bonus shares. What is the addition to its economic resources? Nothing. Money has remained same. Only from resource the figure is transferred to capital, but the resources have remained same. So there is no effect on profit. After the issue of bonus, there is no addition to the profit because resources of the company have remained constant. So whenever there is a bonus issue, any point of time during the year, it is considered for the full 12 months. So after 6 months, even against 1 lakh bonus shares are issued, both will be considered as full 2 lakhs. 1 lakh which are there at the beginning, also 1 lakh. 1 lakh issued after 6 months bonus, they are also considered as 1 lakh. No time weightage is to be given. Not only that, these bonus shares are to be considered as if issued at the beginning of the previous year. So your last year's basic EPS declared will be now restated, adjusted, and revised EPS will be shown in comparison. And there also you will add this 1 lakh shares bonus fully. So that way you will calculate. I'm going to illustration just now after 1 minute. Buyback of shares is a reduction cancellation. So in buyback, there will be outflow of the resources of the company. So profitability will reduce. So you will deduct from, obviously profit is reduced. So you will deduct it from your weighted average number of shares taking time period. Right issue, I'm explaining you with illustration because in right issue, you'll have to do 2 steps first. First, you have to find out theoretical right fair value per share by using this formula. Secondly, you have to find out the right factor for valuation weight. I said you have to give 2 weights, value weights and time weights. Time weights, obviously from right share date of issue will give you time weights. Okay, but for value weights you have to find out the right factor, because normally before right the share price is higher and after right X right price will be lower. So the same shares which are there at before right will be there after right, but their valuation will change. So for that particular factor you are putting right factor multiplying for the pre-right period. How? Let's see. Then we'll go to diluted EPS. Friends, let's see some small questions. I have written illustration 1 oblique SM26. This is in your module, friend, but your module answer is wrong, so I have corrected it. So this is your study material illustration number 26. Then bonus third question is there, which is 27. So I have taken from your module also, but I have tried to revise their answers. So details are, the year seems to be calendar year, January to December, because shares numbers at 1102 is given, then fresh issue for cash on 31st May, then buyback on 111, and then year end December 31st. There are number of shares are given. So what will be, friend? These are now no paid up values given, but they are all considered as fully paid. So there is no question of giving value weights, only have to give time weights. 1800 into 12 by 12 because they are outstanding for the whole year right from the beginning. Then 600 are issued after 5 months. Okay, so their remaining period is for which their money has been used is 7 months. So I will take 600 into 7 by 12. Then 300 shares are bought back on 111. Matlab for 2 months their money is not been used by the company because they are repaid. So I am deducting 300 into 2 by 12. Because it must be out of 1800. Initially I have taken 1800 for 12 months. Out of that, for 300 shares 2 months outstanding period is reduced. So what comes, friend? 1800 plus 350 minus 50, 2100. If anybody has module with him, you can check the answer in your module is not 2100. Friends, is it clear to you? Okay, friends, in fact, I have already given this material to the organizer, so you will get it from Mr. Hemant. Okay, I will share this material. I have already, in fact, shared. Okay, friends, so I hope the first question is clear to everybody. Go to second, partly paid shares, friends. Beginning 1800 shares, 10 is 10 paid. After 10 months, 600 fresh shares are issued for cash, but only 5 is paid up, and they are entitled to participate in proportionate dividend. Okay, so accordingly, friends, how I'll take, as I said, you give 2 weights, 1800 into time weights, 12 by 12 outstanding, amount is also 10 out of 10, so it will be 1800. Then for 600 shares, they are outstanding for only, friends, 2 months out of 12, November, December. Company has used this money to generate profit only for 2 months. So your numerator profit will be considering 2 months money of these 600 shares. So 200 into 12. But again paid up against 10 nominal value, it is only 5. So 2 by 12 is time weightage, 5 by 10 is value weightage. So accordingly, the figure comes 1850. bonus share. So current year profit is, it is calendar year. No, it is not calendar, it is April to March, because 15, 16, 14, 15 is written. So 60 lakhs is current year's profit. Shares up to 31st 12 was 20 lakhs. Then bonus issue on 1/1/16, 2 equity shares for each equity shares outstanding. That is against 20, 40 lakhs shares have been issued as bonus. So in all, after bonus shares come 60 lakhs. So as I said, for bonus shares, no fresh resources are received. Money has remained same constantly. So 60 lakhs profit is generated from the same funds throughout the year. So you will have to take the issue of equity shares not at the beginning of current year, but at the beginning of even previous year. So for the current year, number of shares outstanding will be 20 plus 40 bonus, 60 lakhs. So your current year profit, basic profit, EPS, if I calculate, okay, then it will be rupee 1, 60 lakhs profit divided by 60 lakh shares. So it is 1 rupee. You will have to adjust last year's EPS also, because against 1 year to show the last year's EPS, so it is to be revised, adjusted it is called, yeah, restated. Last year profit was 18 lakhs. Original shares were 20 lakhs last year. So last year's original EPS must be, basic EPS must be 90 paisa. But now you have to revise so it becomes comparable. So it is 18 lakhs divided by 20 lakhs plus 40 lakhs bonus 60 lakhs. So it comes to 0.30. Okay, so the explanation is given by me in the next. Okay, friends. Now I'm going to the another point, right issue. This is your module number 28 question. Here they have given wrong answer, so I'm correcting it, friends. Net profit, it is calendar year, 11 lakhs last year, current year 15 lakhs. Current year shares outstanding prior to right 5 lakhs. Thereafter during the year, right is issued. When? On 1st March. After 2 months in the current year, right is issued. So right shares are outstanding for 10 months, friends. Okay. Fair value of one equity shares immediately prior to exercise right was 21. So first of all, I will have to calculate theoretical X right price. Okay. So what is theoretical X right price? So it is theoretical X right price. So I'm going to this formula. Aggregate fair value of shares immediately prior to right plus proceeds from right divided by number of shares outstanding after right. So friends, rights ke pehle I had how many shares, friends? 5 lakhs. Fair value was 21. So 5 lakhs into 21 plus how many right shares are issued? 1 lakh. 1 lakh at 15 rupees. So 5 lakh into 21 is 1 crore 5 lakhs plus 1 lakh share into 15 is 15. So that comes 120. 120 divided by 6 comes to 20 rupees. Okay. So my right factor is price before right 21. Theoretical X right 20. So 1.5. 1.05 rather. So my basic EPS for current year will be 15 lakhs. My profit divided by, before right there were 5 lakh shares, friends, for 2 months period. What is their value? 21 against X right 20. So I will be taking right, multiplying them with right factor 1.05 into time period 2/12. After right there are 6 lakh shares outstanding for 10 months whose value is 20. So against 21 its value weightage 1. So nothing to write for 1. So this way my figure comes 2.55. So current year basic EPS is 2.55. Not only this, you will have to revise your last year's basic EPS. Last year it was in fact 220. Now you have to take value weights to the last year's shares, because this 5 lakh shares were same there last year. So there also now you will revise 11 lakhs divided by 5 lakhs into 1.05, that comes 2.095. So I am rounding up to 2.10. So friend, if you have a module, check the answer. This is according to me the right answer. Chili friends. Diluted EPS, I'm explaining in short. Whenever company's potential equity shares, because up till now they have not asked diluted equity shares. So whenever company's potential equity shares, there will be diluted EPS to be calculated. Now, what is potential equity shares? Presently, they are not in form of equity shares, but in future they will be converted into equity shares. So in that case, AS assumes if they would have been converted to the equity shares at the beginning of the current year, suppose, then what would have been reduced? If diluted matlab reduce, what would have been your diluted EPS? Okay, suppose there is a convertible debentures as I given in this illustration. They are still convertible debenture at the end of the year. They will be converted into equity shares after 1 year, 2 year, or so on. Suppose they would have been converted to equity share at the beginning of this year, what would have been your basic EPS? That is, diluted EPS, that is to be calculated. So here in this illustration, 1 crore profit, 50 lakhs equity shares outstanding. So 2 rupees is my basic EPS. That is given in the question. But I have 1 lakh convertible debentures. They will be converted after some year into 10 shares. Matlab this 1 lakh debenture into 10 equity shares, there will be 10 equity shares, potential equity shares. Okay. Interest is 10 lakhs. 10 lakhs will be total number of shares. Interest is 12 lakhs and tax thereon, because debenture interest is a deductible expenditure, you know, in income tax. So whenever this debenture will be converted in equity shares, suppose they would have converted at the beginning of the current year, my current year profit would have been increased by 12 lakhs minus 360 tax thereon, that is post-tax debenture interest. Post-tax debenture interest is how much? And this way I have calculated 840 interest minus tax saving thereon. Okay, so if this debenture would have been converted into equity shares from the first day of the current year, my profit would have been 1 lakh plus 8 lakh 40,000, totally 1 lakh 1 crore 8 lakh 40,000. And what would have been number of shares? 50 lakhs plus 10 lakhs, 60 lakhs. So instead of 2 EPS, I would have reduced my EPS, okay, because of this conversion, and it would have come to 1.81. So it has reduced from 2 to 1.81. So it is known as diluted EPS. So basic EPS is 2, diluted EPS is 1.81. That way you have to show. Similarly, there may be convertible preference shares. So there, if they are converted into equity shares right from the beginning, then my PAT profit would have been increased by the preference share dividend plus dividend tax thereon, and thus that will be addition to your numerator. In denominator, you will add number of shares on conversion, and then if that EPS comes lesser than your basic EPS, it is known as diluted EPS. So there can be convertible debentures, potential equity shares, there can be convertible preferences, which are potential equity shares, there can be options, issue, that can also come in this. Okay, but no need to go in so much detail as per your past examination trend. Now friend, I'm coming to one more AS, which comes largely AS 29, which is Ind AS 37, which is regarding provisions, contingent liabilities, and contingent assets, friends. So this deals with 3 aspects. When you have to provide for your liability in books, that is known as provision. When you have to show your liabilities as contingent liabilities, matlab informatively, no entry in books of accounts, that is contingent liabilities. And how to deal with your contingent assets. Okay, so main is provision. When you have to provide for any liability in your books, so there are 3 conditions to be fulfilled. If all these three conditions are fulfilled, then you will have to make its provision in the books, matlab debit the expense and credit the provision for liability. What are these 3 conditions? Recognition. So only main part again, friend, I am touching here, which can affect your performance in examination. A provision shall be recognized when an entity has a present obligation. This obligation may be a legal or may be a constructive, but present obligation, what? So I'm explaining what is present obligation later on. as a result of past event. So past means some event has occurred, as a result, presently you have some obligation, maybe illegal, maybe constructive. Secondly, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. So here they have not used the word cash, they use resources embodying economic benefits. A wider term is used. मतलब future में whenever you will execute this liability, there will be outflow of economic resources. And third, reliable estimate of the amount of obligation can be made. So all these three conditions, see, I have shown the diagram. Present obligation plus probable that outflow will be required plus reliable estimate of cost can be made. Then only you have to make the provision. If any of the three is missing, you should not make the provision in the books. Now, friend, what is present obligation? A present obligation is an obligation, the existence of which on the balance sheet date, based on evidence available, is considered probable. That is more likely than not. Means the probability of the obligation taking place is estimated to be more than 50%. मतलब ये जो आपका फ्यूचर इवेंट है उसकी हैपनिंग के चांसेस, okay, the chances of it being happening in future is more than 50% probability, then only it is considered as present. If it is less than 50% chance of it being occurring, then it is known as possible obligation. And if it is possible obligation, then it will be shown as contingent liability as an information in your financial statement, in books of account. No entry will be passed for that. Okay, suppose friend, I have given one guarantee for 1 lakh rupees loan by another entity. On balance sheet date, his financial position is very strong, so obviously there is no chance of he becoming liquidation is very remote, but anyway 1% is also there. So in that case it is possible obligation that I will have to pay the loan is less than 50%. So it is contingent liability to be shown is information. But suppose he has applied for liquidation and under the liquidation proceeding, it is likely that he will not be able to give any amount of this loan out of his assets. Then obviously as a guarantor, I will have to pay. So the chance, though order has not come, okay, but looking to this liquidation application, it seems, okay, I will have to pay the full amount of loan. So my chances are more than 50%. So I will have to make provision for observing this guarantee in my books, debiting loss and crediting liability. So that is what it is. Now friends, there are certain illustration being given by me, okay, regarding this part. So I'm not going through all, but going through some important elements of this, which may be asked in examination also, friends. So I'm going to 9A. A furnace has a lining that needs to be replaced every 5 years for technical reasons. At the balance sheet date, the lining has been in use for 3 years. So should I provide for expenses for replacement of lining of the furnace at my 3rd year's balance sheet? So obviously answer is no, because still there are 2 years and I'm not sure what I will do after remaining 2 years. That is end of the 5th year. I may replace the furnace totally. So in that case, I will not be required to make these expenditures at this point of time. My incurring these expenses are less than 50% chance. So no provision is recognized, because the reason is cost of replacing the lining is not recognized, because at the balance sheet date no obligation to replace the lining exists. When friends, obligation takes place when you are entering into some agreement with somebody, then only obligation arises. Otherwise there is no question of obligation. I have not contacted anybody to replace. I have not finally decided whether I will replace it or replace the lining or replace the furnace. So there is no obligation, neither legal nor assumed on the balance sheet date, so no provision is required there also. Okay. Then I'm going to, friends, another one more illustration. That is, there is a land, friend, which is I'm extracting oil, and so as a result of this land is contaminated. Second number, I'm referring to second number. An oil company causes contamination but does not clean up because there is no legislation requiring cleaning up. The enterprise has been contaminating land for several years. As at 31st March 05, it is virtually certain that a law requiring cleanup of land already contaminated will be enacted shortly after the year end. So friends, whether should I make provision for this cleaning of the contaminated land or not? Because though presently there is no rule, but it is virtually certain the law is coming in the very short time. So obviously I will be required to clean up the land which is already contaminated in past years, not only future land, but only the land which is already contaminated. That will also be required to be cleaned up. So I will have to make the expenditure. So there is a present obligation. Matlab, my incurring the expense is more than 50%. When I will incur the expense, there will be outflow of economic resources, and asking the contractor what will be the cleaning expenses. I can estimate the expenditure. So provision is required for the best estimate of the cost of the cleanup. So this is some illustration regarding. So whenever there is chance of you making the payment of more than 50%, you have to provide. So you can go through the remaining illustrations as I am providing you the material. Okay, and if you have any doubts, you can contact me later on. Now friends, I've been informed to discuss about one part, that is value added statement. It is not a part of AS, but I have been asked, so I am just referring what is value added statement. Value added statement is nothing but a revised part of your profit and loss. Okay, so your presentation of P&L in a different way, which is more logical for understanding. Okay friends, so what is value addition, friend? I take my illustration. When you come to any teacher, you are raw in knowledge, and then we teach you, give you so much knowledge, and then you become CMA. So this is value addition, from raw material to finished goods. The value addition is called, in a short words, simple words, value additions. Okay, so sales minus bought in cost. This is just a format based. I'm referring the formats. Okay, sales minus bought in cost of material and services, add royalty and other direct incomes, bought in cost of material and services used, friends. So here you take only the payments made to outsiders, not persons who are stakeholders. Now who are stakeholders? I'm coming. Employees are stakeholders because they are the creators of value additions. So in this bought in cost of material and services, only outside services other than employees cost is to be considered. Royalties and other direct incomes valued by manufacturing and trading activities, you will get in that you add investment income, then you add or less extraordinary items, you will get gross value added. And how this gross value added is distributed is applied among 6 parts. I can divide in 7 parts also. One is employees by way of salary, wages. Second, to directors as fees, commission and remuneration. Third, to government as income tax, GST, your local authorities duties, property tax, etc. So that comes. Then comes financials. Now there are 2 types of financials, one lenders, another shareholders. So here financials cost is also considered. Okay, so financials has interest on long-term borrowings like debentures and other term loans. Working capital, friend, is not your long-term borrowings, is a short-term borrowings, you are aware. So interest on working capital is a service provided by the bank. So interest on working capital will come under the borrowing cost of material and services used. But interest on debentures, which are long-term funds, interest on your term loans, which are long-term funds, that will come under item number 4. Okay. Then under 5, another financial shareholders, you pay them its dividends, interim and final, that part will come here. And finally, in the last state, retained earnings. Okay, depreciation is also retained earning and for future expansion. So depreciation is obviously profit set aside for your future replacement of asset, transfer to general reserve. All these things will come under the last element, retained earnings. So your total of, it is like your fund flow statement. In the beginning part, upper part, sources of funds, later part, application of funds. Sources and application should be equal. So that way you have to show. So again, I refer, this is the format, just P&L items. You take your P&L and put under the appropriate head. You will get value added statement. And your sources and application should be tallied. In application, you have to give item wise percentage also. So how much profit is made available to whom, that can be known easily. Now, what is the purpose of friend this? This I have explained you, wherever in the theoretical part. But illustratively, I say, in 92, Britannia Industries Limited, biscuit manufacturing company, which is an MNC, prepared this and presented before the investment community. Because at that time, in 92, our Indian economy was opened before the world and foreign MNCs were invited, okay, to invest in the country. So at that time, so many political parties said that now you are asking another East India Company. East India Company, English people, okay, they came through East India Company and ruled our country for many years, okay. So they say again, we will be slaves, financial slaves. So don't allow these MNCs company to come to India and invest. At that time, Britannia company presented this. This is not mandatory, friends. Remember, no companies that says to prepare this value. It is simply and simply voluntary, no mandatory. So for there is no AS or guidance note on this also. So this format can also be changed. Okay, so there is no specific format on this also. Okay, so Britannia company presented is value added and they show that out of the total profits earned by them, value additions generated by them, only less than 5% is received by their directors and their foreign shareholders. Okay. But are you not able to, or audio is not coming? कोई इंटरनेट चालू करी છે આપણે?
Voice is audible.
Audible. Okay, okay. Because now very few 10-15 minutes hardly is left. Okay. So this way, friends, they said that out of what they earn from India, only 5% they have taken back to their countries. 95% is given to these countries people only. So that way they defended their existence in the country. Similarly, a company like ITC, which pay a huge amount as earlier excise, now GST. If you ask them, this is MNC and cigarettes is health injurious. If you ask them not to sell the cigarettes in India, what will happen? It is the government which will lose a huge amount, because I think this is the company which is paying highest amount of excise duty or GST in our country. So obviously with this purpose they are presenting this. So this is a format base. I have given one illustration. You can refer to this illustration. Okay, it is done just different presentation of financial your profit and loss account only. And friend, last item I am just going through is fair value measurement, because so many times a theoretical question when your paper was theory 1, now it will be obviously totally MCQs, but previously when it was theoretical, sometimes they've asked the questions on this. So I'm just referring to this in a quick session. fair value measurement. Earlier also in Ind AS 16 we have seen fair value is there. Even Ind AS 2 also there is a fair value reference. So it defines fair value, sets out a single Ind AS framework for measuring how to measure fair value, and requires disclosure about. So all normal scope. This Ind AS applies when another Ind AS requires or permits fair value measurement, like I said, Ind AS 16. Then Ind AS 109 financial instrument, which is very important. Okay, that also refers to fair value. 41, which is regarding agriculture, that refers to also. Then disclosure about fair value measurement in Ind AS like 40. So Ind AS 40 is your investment property. Their cost model is to be applied, but you have to show its fair value as information in your balance sheet. So disclosure part. So for this purpose, you have to go for fair valuations. Then case 2, measurements such as fair value as cost to sell. Okay, like in Ind AS 105, even in Ind AS 102 for brokers and traders in these goods, we have seen that they have to value their inventories at fair value less cost to sell. So that is also defined here, and disclosure about this. It does not apply to Ind AS 102, 116, NRV. NRV and fair value both are different things, friends. They are not the same things. Maybe at times same, but not necessarily same all the times. So this is not same as NRV. And value in use in case of impairment of assets. So in Ind AS 16, I referred impairment of assets when CA exceeds RA, and RA is the higher of the two things, NRSV and value in use. Value in use is PV of future cash flows. So for that fair value is not as per this, there it is fair PV of future cash flows. So these are excluded. Also disclosure are not required under Ind AS 19, that is employee benefits, and Ind AS 36, that is I said impairment of assets, friends. So now just I'm going to some important theories. What is fair value, friend? As I said earlier, it is the exit price. It is the price. There are two prices: entry, purchase, and exit, sale. It is a price that would be received to sell an asset or pay to transfer a liability in an orderly transaction in the principal or most advantageous market. So there are two types of market which I'm explaining: principal and most advantageous. A question has already come in the past on this. Between market participants at the measurement date, regardless of whether price is directly observable or estimated using another valuation technique. Thus, definition focuses on assets and liabilities and not to incomes and expenses. So this is fair valuation is always of asset or liability. Definition also says receive to sell an asset or pay to transfer a liability. It doesn't refer to what is the fair value of an asset or of fair value of an income or fair value of an expense. So fair value is market based on measurement, most likely a hypothetical situation, not actual situation, and is not entity specific measurement. Now friends, what is orderly transaction? It assumes exposure to market, general market, and considers for marketing activities that are usual and customary for transaction involving such assets and liability. So it doesn't, ordinary transaction does not include a forced liquidation or distressed sale of the asset. So in normal situation, what people will do, what the market participants will do, that is assumed. So usual and customary transaction are included in ordinarily transaction as defined in the definition. Okay, then fair value measurement assumes that the transaction to sell the asset or transfer the liability takes place either in principal market or most advantageous market. Now what is principal market? I have highlighted is the market with the greatest volume and level of activity for the asset or liability. Like example, BSE has greatest volume and activity than NSE, Bombay Stock Exchange, National Stock Exchange. Okay, so where there is a large volume of transaction, that is known as principal market. Okay, whereas most advantageous market is a market that maximizes the amount that would be received to sell the asset or minimize the amount that would be paid to transfer the liability after deducting both transaction and transportation cost. So most advantageous matlab where you get the highest price. Okay, All the now there are two types of costs are incurred when you sell the asset. One is transaction cost like brokerage. Another is transportation cost. Matlab you have to give the delivery to the market. So that is transportation cost. So when you find the price, whether of principal market or most advantageous market, okay. So all the transaction costs are deducted while determining which market is most advantageous. The price used to measure the fair value of the asset is not adjusted for transaction cost, although it is adjusted for transport cost. So for principal and most advantageous market, friend, you will deduct both transaction cost as well as transportation cost. In case of most advantageous market, you will find the highest, and then from that highest you will add back your transaction cost, or rather your transaction cost, to get your how. Let's see. So one illustration, Patafat. A product has got a domestic market where the prices are lesser comparing to the price available for export market. So companies manufacture the goods which are sellable in local market as well as in export market. But the government has a policy to put a cap, restrict the export of that product maximum to 10% of the total output by any such manufacturer. Matlab company cannot export more than 10% of its total output. 90% it has to sell in the local market for every manufacturer in this industry. The normal activities of product are being done at domestic market only. So 90% of the goods are sold in domestic market. Only 10% can be exported. The highest level of activities with highest volume is being done at domestic market. Hence the principal market for the product will be domestic. So principal is one where there is highest volume, highest level of activities, irrespective of price. But export prices are suppose more than the price in the principal market, and it would give highest return comparing to domestic market. In that case, export market would be considered as most advantageous, because most advantageous is one where you get the highest price. So in export you get higher price than the domestic price. So export price is most advantageous, whereas principal market is domestic. Most advantageous is export market. So that's why this classification is there. Then a question can ask on valuation techniques, market approach, income approach, cost approach. Already a theory has been asked. I'm explaining very short. Market approach, but how you take the fair value, price in the market, which market you will consider. The market approach, quoted price in an exchange, like equity shares, futures. If for my asset, I have, suppose it is investment in equity shares over RIL, so I can get a market price easily from NSE BSE market. Okay, so I have entered the future of Reliance share, I can get the future price also. So that price I will take as base of my fair value and is known as market approach. So market approach is available for, it refers to the quoted price. But for every asset, quoted price may not be available because they are not listed anywhere. So for unlisted equity instruments, you can go for income approach, and income approach takes present value of future cash flows. So this is one way of valuation you might have learned in goodwill share, okay, annuity method, which is present value of future cash flows. And that way you decide the value of your unlisted equity shares instruments. So that is called income approach. And the third is cost approach. It is depreciated replacement cost method. For factory plant, property equipment, you can go for, when you go for revaluation, you take depreciated replacement cost. Okay, so that is called cost approach. So three approaches are, first preference is market approach, then second is income, third is cost. Any of these you can go depending upon the available information. Now the information which is available can be of three types, friends. So fair value hierarchy. This is also a question asked theoretically in the past. There are three levels of input informations available: level 1, level 2, level 3. Level 1 are quoted prices. So whatever the price available from the active market for identical assets or liabilities, that is to be used first. Okay, so this is the first preference. Like I said, for quoted shares, NSE's price can be taken as level 1 input. Matlab you prefer that price first if it is available. Second, if it is not available, then level 2 inputs are inputs other than quoted prices included within level 1 that are observable for the assets and liabilities, either directly or indirectly. Means an entity has investment in another entity which has no active market. But I have invested in shares of a company which is not listed. Then how will I value its some similar investments being traded in active market? There is a company similar to Reliance. I've invested in that company's shares. Its market price is not available. But I have similar company, Reliance company's market share available. Both are similar companies, same level companies. So I can take Reliance company's price as the base for this. So that is most observable for me. Okay. So similar type of investment is there, then which are actively traded. I can take its price as my fair valuation. And suppose that is also not available, no such comparison figure is also available, then level 3 inputs is called, it is unobservable inputs for assets and liabilities. They should be developed using based information available in the circumstances, which might include entities, matlab forecast. You have to just go for forecasted figures, projected figures, and based on that, you have to take these figures. And finally, friends, application to non-financial assets, this part, and then I've given a chart regarding this, friends. So friends, here I am my time is over, so I am concluding my part. So friends, today we have seen Ind AS 16, Ind AS 2, AS 7, Ind AS 108 segment reporting, then 33, that is AS 20 EPS, then Ind AS 37, which is AS 29, provisions, contingent liability, contingent assets, value added statement, and finally this 113 fair value additions. So friends, thank you very much. Okay, I'm just going to your questions. If anybody has any questions. Okay, friends, no questions is there. Even if there is question, you can contact me through. Okay, so thank you very much to all of my dear students, and wish you first of all happy Diwali, because that is coming next, and then best of luck for your December examinations. And I hope this will be held as per schedule and not delayed. Okay, because you all must be now tired of this preparation. So okay, so thank you very much, friends. All the best. Okay, so
Thank you so much.
okay, so
Thank you so
sorry.
much, sir, for your valuable time and explain the accounting standard exercise to clear the concept of the student. So thank you so much, sir.
Okay,
Can
I
I
hope
end the
so.
session?
Yes. Okay. Sorry for some disturbances, but thank you very much for cooperating, friends. Okay, so I'm taking your leave.
Okay,
Thank you.
okay, sir. Thank you.